So hopefully everyone can see the slide deck now, and we'll start working through that. So yeah, the session is sort of like the tax and so the tax implications and director remuneration planning essentially. So we sent around a bit of a poll to clients to say, look, what kind of topics would you like us to support on? And this was the most popular. So we're going to, like I say, try and put on something monthly to, like I say, add a bit of value, and we'll circle it around as well so everyone's got access to it. I can't actually see anything except for my presentation. So if there's any questions, I'll try and fire through them at the end. Is probably going to be the best way to do it. So yeah, just go through sort of the webinar agenda, what we've got planned to go through. So how can you make your remuneration as tax efficient as possible? So we're just going to try and provide a bit of almost financial education on the sort of how the tax system works, and then and answer some questions from that perspective. I've got Tom joining me from Gravitate. He's going to bring his laptop in, and then, like I say, at least if we do have some questions, I can see them and start trying to answer them live as opposed to going back. Then, like I say, maximise your net income and reduce personal spend. So one of the things we talk to our clients quite a lot about is from an income side is what we want to work with our clients is on what can we get them to put through their business essentially. If we can get certain costs through the business, then there's going to be the sort of the tax benefits of doing that, and like I say, it saves you drawing the money out and paying for it personally. Can you jump on the meeting?
Yes.
Obviously mute it and stuff. Then obviously staying compliant is a key part of what we're doing. Like I say, we always talk about acting on our clients' behalf. So that's our aim. But equally, we are going to tell you what is right and wrong. And like I say, the last thing we want is to try and save a few pounds at the detriment of ending up in prison. So yeah, that falls as part of our responsibility. Then it's the sort of the payments on account and how they work, because like I say, they can certainly be confusing at times. So yeah, we'll just go through briefly how that works, a little bit on your personal cash flow, and then I suppose what we're then looking at is, okay, all these points apply to you as company directors and company owners. Which of those elements can you start applying to your team essentially? So it's sort of like we're looking at it from your side, but like there's certain things that we can use that are benefits to directors that we can always also use for staff. So the first sort of section is all about your remuneration and making it as tax efficient as possible. So I say some people will know this, some people won't. So this is sort of how the income tax system works. So essentially, the first £12,570 you earn is tax free. You then move into the basic rate band, which takes you from 12,571 up to 50,270, and then higher rate tax earners are 50,000 up to 125, and then 125 and over is the additional rate, and it sort of goes through the tax implications, both as someone who's employed and having employment income versus the dividend tax, and so from this perspective, there's quite a lot of sort of nuances to it. So we go into off the back of this, like things like pensions and child benefits and stuff like that. So we started writing this slide, and it sort of certainly evolved. But what you'll see as a fairly common exercise is people will take the salary of the 12,570, and I might end up jumping in between slides a little bit here. So the reason why people take that £12,570 is because it's going back to here. It's within that personal allowance, so the individual isn't paying tax on it. And then if you think of, like I say, from a limited company perspective, where we're getting the tax relief, well, the tax relief falls within here, within expenses. And so by paying this £12,570, the actual the cost to the company is £12,570 less less the tax saving of 25%, because it falls at this level. It's before your tax is calculated, and therefore, like you say, your company from a company's perspective will see a saving. Whilst how it differs to the dividends is, well, you've got your profit before tax, which your corporation tax is based on, giving you a profit after tax figure. And then this is when the dividends come into play. So the dividends come at that lower position. And so going back here, a lot of people will say, "Oh, the sort of the benefits are significantly higher from a dividend tax perspective." So you can see here the rates are far lower, but it is always important to look at the full picture and say, okay, but in order for you to be able to pay a dividend, because of where it falls on your chart of accounts, you are going to have pay tax either 9 and 25%. Obviously, they've complicated the tax regime for limited companies recently. And so it's not always a straightforward, you can compare these taxes to make those decisions for you as business owners. And generally speaking, in years gone by, that you used to be able to dividends. You used to be able to effectively get pay dividends up to £50,000 with zero tax. But obviously, there has been a sort of constant reduction in the benefits of limited companies, essentially. So now we still see a benefit, and we sort of do these country sums every year based on the changes in the tax law, and we would say that up to around the £98,000 mark is where it's still beneficial to run it as a low salary of £12,570, then topped up by dividend. But if you're getting up to that 98 or £100,000 point, then it's always worth just flagging with us as your accountants to say, okay, I'm getting close to that. What are my options? Because I suppose the second piece to that advice is, although your tax position's better, your cash position changes. And so obviously when you receive dividends, you will essentially, if you're receiving a dividend now in May 2025, you're going to put that on your tax return in April 26, and you're going to be paying the tax on it the following January. So there's a massive cash flow benefit from a personal perspective to paying dividends. So again, the question isn't which gets me in that lowest tax position. The question is, okay, I know if I pay myself 100k, I might be a few pounds better off in tax by going down the payroll route. But if I was to go down the payroll route and pay myself the £100,000, what I'm going to see is the company's going to have to pay national insurance. I'm going to personally pay national insurance, and so my net pay will go from, I say, 100k. You're talking what, £8,000 a month you would receive when you take your salary and your gross dividend. But when that becomes the equivalent in a salary, it's going to be a far significantly lower number. But you're not going to have those chunky tax payments in January and in July each year. So like I say, it's something everyone should be aware of. And there's no right or wrong answer, because there's so many different elements to it. There's the fact that we've got a changing tax rate, which will help make your decision. There's, like I say, how the dividend tax rate interacts with that. And then, like you say, there's that other point of the personal cash flow element. So plenty to consider, and I suppose that's why we're here. I can see the questions. So if anyone does ask questions throughout, I'm happy for this to be fairly interactive. If I mention anything in this call and you're like, oh, I want to know more, either drop me an email, or obviously you'll have a client contact, a client FD who supports you. So again, I'm sure they'll happily be able to pick up those some points with you as well. So then just going through a few of these key points underneath. So 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 when your income we've got passes, so this should be say £100,000. Sorry. So when your income passes £100,000, one thing we talk a lot about is, and you'll hear, is sort of like this 60% tax trap. So let's pretend that says, instead of saying 125, 140 here, it's saying 100,000. But whenever you start earning over £100,000, you essentially start losing your personal allowance. And so every £1,000 you earn above £100,000, you're losing part of your personal allowance. And so that's why people talk about this 60% tax trap, because, like I say, for every £1,000 you lose, £1,000 you earn, you lose £500 of your personal allowance. So that means that's bringing that £500 under taxable income. And so, like I say, by the time you get to this 125, 140 number, you'll have lost your full personal allowance. And so, it's like I say, so you end up paying tax at 60%. And so, as soon as you're closing in on that number again, we would be working with you to say, look, you need to think about, do you need this cash in your business bank account? In your personal bank account, do you need this to live off? And is there other ways of doing it? So, for example, if you need to get more money into your household, could you employ a family member? Or if it's about you've got the money in the business bank account, so you want ways of extracting it, it could be a case of, okay, why don't we look at paying some money into pensions, or why don't we look at other investments that you can do for the business, which doesn't take you over that £100,000 mark and doesn't lead to you getting taxed at that rate of 60%, which is the effective rate it comes in at, roughly. And so 100 grand's a big number for that reason. It's even more important of a figure when you're considering if you've got young children who are at nursery, and that's because so there's two elements. You start losing your child benefit when you earn over £60,000, and that starts to be scaled down. So that's not an instant drop off, but it's a number to be aware of. But then, we think the cost to an individual, to a family, is typically a few £1,000s to that. But the cost of losing the 3 hours at nursery, and this is if you earned £100,001, it is a sort of a case of it goes. And so you go from, like say, £100,000. Anything above that, you're not only paying tax at this extortionate rate, you also instantly lose those 3 hours. So, like I say, £1 over, and you lose all those 3 hours. And so, luckily, as business owners who have accountants, you'll typically have these conversations. If you can imagine employees who don't have access to accountants, then typically, if they're going to start going over this mark, if they might earn 90k and get a bonus, for example, which takes them over, and they'll be delighted they've got a bonus. But unless they've got a good employer who will recognise, okay, the impact of that, it can be quite significant. So, like I say, if you do have staff members who are earning in and around that £100,000 mark, you should, as a sort of an employer who cares, you should. I mean, we would talk to them. There's not a whole lot of work in it for us, but as your accountants and support you guys, we would happily have a chat to them and say, look, there is some things you can do. Again, we'd work with you as clients of ours to say, look, we could start making pension contributions, larger pension contributions on their behalf, things like that. So there's plenty we can do, and yeah, it's all about identifying that and and making sure, like you say, especially when you're getting close to that £100,000 mark, we're having conversations. Like so, it's sort of been through that and how those interact. The state pension, because like I say, I suppose as part of this financial education piece, what we're trying to do is bring everything together. And so another benefit of paying that £12,570 figure is by paying that, you're getting a tick for your state pension. So and the number to get that is £6,500. So if you're putting £6,500 through your payroll each year, then you're going to qualify for that taking your state pension. And then, like I say, if you get the 35 years, you'll qualify for the full amount, which is what everyone should be aiming to do. So if you've previously been in employment, and if you've been in employment for 35 years, and you're generally speaking, you'll probably earn over £6,500 unless you've been in one of the earlier apprentices style schemes, and obviously that number will change over the years as well. You will have qualified, but for those people who are, I don't want to actually put any payroll through my business, this is another big reason to do it, because, like you say, you'll qualify. You need to get those 35 years. There is ways you can backdate it, but again, they have changed recently. But yeah, it's just also always worth flagging that, because then when we go back to this page about the up to the 12,570, well, because some people they'll have is benefit in kinds. So if you imagine if you took a salary of £12,570 and you had some benefit in kind, so if you start having a benefit in kind is things like company cars or private medical and stuff like that go through your business, that might bump you over the 12,570, and so you're going to start paying some tax at 20% as opposed to the 8.75% figure here. So again, there could be a conversation there to say, okay, well, actually, I want to reduce my salary down from that 12,570 to 12,570, but to allow for the benefit in kind that's going through my company. But I wouldn't want to go too far below, because, like I say, if you drop below that 6,500 figure from the pension side, then you're causing a problem later down the line. So it's almost worth suffering a bit of tax now to benefit from that the state pension, basically, when we get there. So yeah, I think it's you can sort of see how the company side, the personal side, and all the pensions are tying in with one another essentially, to help how we sort of plan through this. Again, because we're talking about pensions, it's worth just having a quick overview. So again, when we're talking to owners of limited companies, sorry, I'm flicking around a little bit, but where possible, we are looking at getting the pension paid directly from the company, because you obviously can see here the pension comes in before tax. So if, for example, you wanted to contribute £20,000 to your pension, the company is going to get that instant tax saving of 25%, and so there's a real benefit there. So that's where this element's coming in. So it comes through as the sort of the pre-tax profits, and that's where it's introduced. And then you say, you get that corporation tax relief at 25%. There is an annual allowance of £60,000, and again, that's changed recently. There is an option to also carry that back. But yeah, this tends to be for the business owners who are taking out the money they want from their business. So whether that's, some people take themselves up to that £50,000 mark, 270. Some will take them and their partner up to that number. Some will take themselves up to the £100,000 mark and stop there. I mean, some will blitz past it, obviously, but generally speaking, a lot of the businesses we deal with are either trying to get themselves up to that £50,000 mark, and then the same for their family members, because of this tax rate of 8.75% for dividends, or they're going up to the £100,000 mark. Like I say, ignoring this 125 limit because of that 60% tax trap, basically. And so when it comes to pension contributions, so these individuals have got themselves up to that 50k mark, or they've got themselves up to that 100k mark. They're happy with the money that they're paying, that they're taking out of the business, and they're living off. And then they're now like, okay, but I've got cash building up in my business. What can I do next? And pensions is the obvious one, because, like you say, you can contribute £60,000 into your pension, and you're saving 25% of that, up to 25%, because of the scale up of the tax. But generally, if you're affording to be able to take out 60k, the likelihood is you're probably paying tax at a higher rate anyway. And yeah, so if you're in that position where you've got cash surplus in your bank, you're benefiting from a sort of a 25% uplift, because the cost of the company is 60 grand less corporation tax, so 45 grand. But you've got that money out of the business into your personal savings account, and then, like you say, you benefit from the growth of that pension pot over time as well. So yeah, it's something we talk to clients about. I suppose there is other things you can do. Again, we can't advise on everything. I certainly recommend, if you're starting looking at significant pension contributions and similar things like that, to get an advisor in place. But I think I can talk about what I do. So one thing that I do is you can make investments, essentially. So there's things like VCTs, venture capital trusts, EIS schemes, SEIS schemes. And so what I do is invest into a VCT, which is, like I say, a venture capital trust. It means if you're earning £50,000, but you've got money in your bank, but what you're trying to avoid doing is paying tax at this 33.75% mark, you can take that money out. So you're going to pay tax at 33.75%, but you invest it in, like I say, a VCT. So how it works for me, I'm putting money into scale up businesses. Some like the alcohol-free beers are in there. It's sort of like a portfolio of investments. And it means that I'm paying 33.75% to take it out, but then I get what is called like 30% tax relief on it. And so it means that I can take a little bit more out of my business. My effective rate of tax is only 3.75%, because I pay the 33.75% to get it out, but then because I'm investing it straight into VCT, I get tax relief at 30% of what I invest. So the actual cost is 3.75%. And again, it's out of the business, which is sometimes businesses do struggle as they scale. And they have all their wealth is stored within the business. But yeah, it's a way of getting that money out of the business, invest in it, and like I say, the effective rate of tax is 3.75%, and you're invested in something personally. You leave it in for 5 years, and then you've got the opportunity to take it out, essentially. So again, all this kind of stuff, the pension stuff, VCTs, EIS, SCIS, is where I'd always recommend speaking to a financial advisor. I'm always happy to chat about what I do, and can talk through that in a little bit more detail. But like I say, it's not something we specifically advise on. This is a topic that we're really passionate about, to be fair, and it's all about maximising your net income and reducing personal spend. The company cars is probably a prime example, because of the significant cost of owning a car, essentially. So what we're talking about here is the difference between you thinking, oh, I'm going to lease a car in my own name, or I am going to put it through the company, and sort of the tax benefits. There's a few assumptions in here, and like you say, we do these calculations for clients quite frequently. So anyone who is on this call and is thinking about making a change with regards to the cars, then like I say, we can't do one example here that fits all, but what this is basically saying is we've took an example of just a 60k car. We put the number out of thin air really, with a gross cost per month of £400. So we're saying this individual is already earning 50k or above. So if they're going to take any more money out to get a car personally, it's going to be taxed at 33.75%. And so what we're saying is, if you want to receive £400 to if you want to receive £400 into your back pocket, then you're going to have a dividend of £603 because you're going to be paying tax at 33.75%. And so to be able to cover that, to get to that £400 number. But the company, that is exactly the same car, because the deals are generally the same now. If you look at them, sometimes the prices look different, but largely because one's quoted with and one's quoted without VAT. So again, the company pays for it, so it's £333 plus that. Again, this situation isn't perfect for everyone because some companies aren't VAT registered, some companies aren't able to recover some of the VAT, but we're assuming on based on these numbers that you are VAT registered. So how it works is, if you're going to lease an electric car through your company, basically HMRC say, well, some of it's going to be personal, some of it's going to be business. So what we're going to do, we're going to allow you to recover half of the VAT. So essentially what ends up happening is you're paying the net price plus 10%. So that's the cost of the company, 366. But because, like I say, anything you can get through the company that is an allowable cost, you're going to get this tax saving. Again, we've assumed at 25% for this calculation. One thing to consider is there is the benefit in kind tax. So the reason why we specifically talk about electric vehicles is because they have the most beneficial rate of benefit in kind tax. The government incentivized people to go electric essentially, and so, like you say, the tax, the benefit in kind is 3%. If you compared that to a typical I don't know, like your run-of-the-mill car with mid-range emissions, that percentage can be like 30-40%. And so what that means is, what benefit in kind from the car perspective is saying, well, the car's worth 660k, we're going to charge you 3% of the cost price to buy it as a benefit, and that goes on to your income. So say if you earned £12,570 as a salary, plus you took dividends of 24,000, so you're on about that 36k. Well, this would take you up to around the 38k number in this example. So that, whatever that number works out as, is just bolted onto your income, and then you, like you say, it sort of affects the tax rates you're paying at. But then also the company will also have to pay national insurance on that, because what HMRC are saying is, well, they're giving you a benefit of, you're giving your employees the benefit of £1,800 or yourselves as directors. We want to have a piece of that pie, so we're going to get our 15% national insurance on that. So we're going to charge a little bit of money as well, which will be £270. But again, there's tax relief on that, so that comes down to 202. And so where we're getting to with this is, okay, so what is the cost in both these examples? So the cost of the company to pay you the dividends to extract the money is 7.2 thousand. But what is the cost of costs to the company of putting it through the business after all the tax savings available? And it comes to £3,502. So you can see, this is, like I say, it's a realistic example, but if you're not registered for VAT, if you're also not, if you're paying tax at the 8.75%, the swing will be different. And that's why I'm saying, look, we do these calculations for clients happily. If you've got any questions, please let us know. But this is the kind of thing you can be thinking about, not only for yourselves, but your team as well. So, and like I say, sometimes there is there's a bit of effort in calculating them. So that's why you'll typically see people, if you're going to roll this out to your employees, you typically see them using a scheme like Octopus as an example. Like say, if you've got 2 or 3 people, you don't really want to be managing that full process. What they deal with is well, they'll manage it from a perspective of what happens if they leave, and you'll have agreements with them that you can return the cars and stuff like that. So again, this is way bigger picture from an employee's perspective, but as you can see, like as directors of companies, there is a huge benefit of getting these company cars for your business. And again, I suppose the key emphasis there is on electric cars. There is certainly benefits to there's certainly benefits there as well to hybrid cars. And again, it's just speaking to the I suppose the people who are selling the cars and getting confirmation on that benefit in kind rate. Like I say, for fully electric cars, it's 3%. Hybrid cars is done on the number of electric miles. So, for example, at one point I had a Audi A3 something or other, and that did about 20 electric miles, which obviously in the grand scheme of things is nothing. So the benefit in kind on that was just, it wasn't through the business, it's buying personally. It's still significant, but some of the bigger cars are doing more and more electric miles. So I appreciate not everyone loves electric cars, and some people it's just not practical for as well. But yeah, if that was the thing that put you off, if you can get the electric cars that do a high level of electric mileage, so that's what it's judged on, then like you say, there is still the benefit there, and especially those people who tick all those boxes, VAT registered, earning above the £50,000 mark, there's significant benefits. So that's an example, but the same like logic applies to all of these things really. Like mobile phones is another one where if you're paying for a mobile phone personally, the chances are, like say, whatever, £50 a month. Well, actually, you've got to be saying as a business owner, well, actually, I'm suffering a cost of a dividend of £80 to then pay tax on that, to pay that £50 personally. So would it be possible to get a business contract? And I say they tend to be a little bit more, but not 33% more kind of thing. So that's the mindset we try and get into, and be looking at what can we get through to go through the business, get the corporation tax rate saving, and like I say, the mobile phone's another prime example. You're talking, let's say, £60 to have that contract, which is £50 plus VAT. So again, you're closing in on probably £90 to £100 to get that money out of the business, versus if it's £50 plus VAT, so you're saving the VAT plus you're saving the corporation tax, you're comparing like £37.50 to put it through the company to £90, £100 to pay the tax to get it out and pay it personally. So yeah, I think we're here to fight on your side, and things like say pension contributions, the work meals, like Christmas parties, all these things, it's good to try and get these costs through the business where you can. I feel like I missed a slide there. Was there one more slide? No, maybe not then. I suppose yeah, the other side to that is obviously certain things will create a benefit in kind, things like company cars. There's also certain insurances that we always advise, like if you're paying for life insurance personally, have you looked at the opportunity of putting through the business? Some of it will class as a benefit in kind, like then there'll be certain things like relevant life cover, which you can actually put through the business at no benefit in kind. So yeah, insurances, company cars, mobile phones, pension stuff, those are the ones that we're always looking at and saying, okay, what's best for you and your business, you as an individual and the business as a whole, to get through the business, and what's better for you to go through personally. Yeah, I think one obviously we mentioned about the bit at the start about being compliant. When you're looking at your tax return, I think it's just having that knowledge of if I am doing a transaction, so things like crypto as an example, you're physically buying and selling investments. It's making sure that you have that consideration that is there is an element of this that probably could be taxable, and like I say, it's almost would rather you tell us too much than too little. When it comes to from that perspective, there's been certain changes with buying and selling houses, so you've got to declare those within a much shorter window now as well. So again, the more we can be involved in those conversations where our clients are involved in transactions, and there might even be certain reliefs or certain planning opportunities we can take advantage of to enable you to hold that certain asset in the right place to get the best position for you. So we do, like I say, we have a blog on that, and I think when those who we do self-assessment tax returns for, you'll have sort of seen a full detailed list that we're trying to set out everything that you could be coming to this tax return, just to try and help you sort of trigger you to say, oh, right, yeah, I do need to be discussing that with our accountants. We sort of touched on it a little bit earlier about, like you say, when you're extracting money from a business and the payments on account stuff. Like you say, that I think this is one thing that HMRC will look to work on, because imagine if you started a business today and started taking dividends, like we said in that first example, your first tax payment, you declare it in March 26 and you'd pay it in January 27. So you could be receiving dividends and not paying tax on it for 21 months essentially. And so this is something that, like I say, at the minute that's a system, and one of the few benefits left to business owners is that. But I think what we're trying to advise on is make sure you're not stung by this, because as your income grows and as you come into that, well, when your income gets to a certain level essentially, and you're being forced to pay payments on account, then you can see a sudden tax hit, because, like you say, you might go from year one to not having to pay a payment on account. But when you fall under that position where you need to start paying a payment on account in that January, you're essentially paying for 1 year's tax in the prior years, but 50% of next year's tax as well. And so one of the services we offer is sort of like a remuneration planning session, where we say, okay, look, what you plan on taking out in this year and next year, and let's start planning what those tax payments are going to look like. Because if you're fully aware of what your tax payments are looking like for January and July, you can start putting money to one side within your personal bank, or even some people keep it in their business bank as money owed to them. And like I say, it's just good practice. And so generally speaking, how it works, so if someone has a £6,000 tax bill, there'll be certain people who have slightly more complex tax calculations, things like with the VCT stuff that I mentioned earlier, that will impact this calculation. But we're just talking like a plain and simple, your tax position is £6,000, because another thing that would typically impact it would be student loans. Like, say, the student loan payable doesn't actually make up part of your payment on account. So again, for anyone who has got a student loan, it's something that impacted me as because I would be paying payments on account towards my tax bill, but then every January I'd also have to pay my student loan contribution as well. So again, that caught me out a little bit in the past. So it's been worth being aware of. But like I say, this is a simple example, £6,000. So what they do, they literally half that number and say, okay, well, so you're going to have £6,000 to pay 31st of January. What we're also going to do is start taking this payment on account towards next year as well. So we're gonna charge you £3,000 towards January 26's payment, and then we're going to take the following payment in July. Again, so 6,000. And so how if you are literally, it's highly unlikely, but if you, because of the changes in tax rates and stuff, but if your tax bill was to be £6,000 every year, bang on, you would basically pay the payment on account in January, payment on account in July, and then you'd have nothing to pay to top it, no balance to pay. It's only as that balance is increasing that you'll really see the impact. So in this example, we then see the tax bill going up to £6,500. Well, we've already paid 3,000 the prior January. We've already paid a second payment on account in July of £3,000. So therefore, we paid 6,000. So how it's going to work is we're going to pay, like I say, the balancing payment of the £500, and then like I say, the next lot of payments on account are then 3,250, which again is just half of this number essentially. And like you say, you'll see it grow like that. And again, we do get people who aren't planning for that. So like I say, we do offer a service where we can support on that. As remuneration planning is something that we haven't always offered, but we had so many people who are like, oh yeah, these payments in January and July just catch me out a little bit. I'm not putting enough money to one side. What can we do? Like I say, our aim is to do the tax return. So like there's nothing we'd want more than to start getting everyone's tax returns filed now. So anyone who does want to know what their tax position is going to be for January next year, definitely start getting the information over to us, and we'll happily get your tax returns filed, because that gives you that it gives you your tax figure for January next year now, essentially, and so you can start making those plans accordingly, as opposed to potentially having to leave it till the back end of this year and then having a shorter period of time to sort of be prepared to get your tax paid, essentially. And then we sort of go on to from looking at you as individuals to say, okay, how can we apply some of this logic to your staff? Because, like you say, if you're doing these things for you as business owners, could you be offering similar stuff to your employees, essentially? So, like you say, it's employer pension contributions, parking, eye tests, all these things, and like you say, it generally comes as a cost to business owners, and like I say, everyone appreciates right now that costs are tight, but it's almost balancing out like the retention piece versus, like I say, additional costs to suffer for the business. So we're certainly not saying just roll all these out and do them, because yes, there's a tax saving, but the bigger picture is there's a cost to you as a business owner. It's more centred on, okay, knowing what could be available, and like I say, should you want to offer them to staff, they would appreciate it. Again, like I said, there's benefit in kind stuff. So I suppose these are more like the tax-free stuff you can offer to your team. This is more going down, okay, there's this sort of benefits you can put through that will be taxable, but it's still basically there's still a benefit. So like say the company car, what you would typically do is you reduce the person's salary and offer them a car in its place. And you do that calculation, so it's offering more opportunity for the team to benefit from, like you say, saving money at that lower tax rate, like you are doing as business directors. And again, it's not always straightforward, because, like you say, things like company cars, you're often tying yourself in for a certain length of time. But like the likes of private health insurance, gym memberships, you do see certain companies offering things like, I mean, as an example, we offer Medicash, which is our team will receive an amount that they can contribute towards things like glasses, physiotherapy, mental health support, all those things and we pay one fixed monthly fee, and like I say, they get a limit for each one of those, for each of these different areas, kind of thing. So private health insurance is one, but like you say, you see the Boopers do these Aviva, but there's all these other like company perks kind of thing. I think the key thing with those is finding something the staff want. So we tend to let our staff vote on, if you could pick any benefits, what would be the ones you wanted. And like I said, we obviously just don't just give them everything, but we then try and pick a couple that are highly ranked by the team to say, okay, that's something we can look into. And that's how down the line we've ended up with like Office Free and mobile phones at a certain level. We ask our team obviously to be really reactive and support our clients, and they're like, okay, they've now got my personal number, now what we're going to do. So again, it's sort of like, yeah, although we want them to be reactive, they shouldn't be impacted at weekends and stuff. So off the back of getting that feedback from the team, the people who are doing that high level of contact stuff, we got them mobile phones. And obviously, as we've been through on this presentation, there's benefits to the employee, we get the tax relief and stuff like that. And so yeah, it's worked out fairly well for us. And then I suppose the last thing is to almost going back to the start and how we're seeing directors take the money, the salary dividend split. Well, we're increasingly now in a position where staff are integral. It's different for every business, obviously, but for our business, our team holds so many relationships and stuff like that. And so we now get to a point where we're like, okay, we need to find ways to retain them, and that comes down to, for us, is we offer them a potential into like a share scheme. So again, this is pretty high level stuff, and we've got Martin who does our corporate finance, who can back through options with this. But how we do it is do growth shares. So the nice thing about growth shares is you can create growth shares and give them to staff members, and because at that day that share is worth nothing, it's only worth something on the growth. So you'd essentially value the business today. So say if our business was worth 500k today and we gave someone shares, and then they wanted to sell those shares 10 years time for £1.5 million. So their value isn't £1.5 million, it's the £1 million growth it's received, because they bought in it, or they received shares at the 500k mark, and so they would get 1 or 2%, whatever you agreed to give them, of that growth of the £1 million. But it still gives them something. And then, like you say, going back to the start, it opens up that tax planning route for those for employees as well, where you could reward them with dividends as well, based on performance. So yeah, I feel like we started this topic with the sort of the salary, with the direct remuneration planning, but like all things with accountancy, it sort of feels like it branches out into various different areas. So yeah, hopefully some of that information was fairly useful. Our hope is to try and do these kind of webinars once a month. We'll like I say, we'll keep getting feedback from you guys to say, look, what topics would you like us to cover? What would be beneficial to you? Like I say, we've got the corporate finance side. We can do some quite tax specific stuff. We can do like buying and selling businesses. There's loads of options that we can cover. And again, we'll just keep leaning on you guys. If anyone wants to email me after this and say, that was really useful or that was really rubbish, and I'd rather you covered X, Y, and Z, I'm honestly really happy to hear it, because we just want to create content and information that helps our clients, essentially. So has anyone got any questions? Was it okay? Shall we leave it at that? Luckily one person is typing, so we'll wait to see how that comes out, and then got a couple. No questions. That's good. Yeah, like honestly, guys, all we ever want to do is receive feedback. And you probably get fed up with us asking for feedback from you But it is just because we want to do better and we want to provide more support and help. So thank you very much for the kind comments. And like you say, we will continue to produce them. If anyone has any questions, my email is sam@gravitate.digital. If you haven't emailed me before, it's just the same as the rest of the guys. But yeah, like I say, I'm in a position now where my focus is more supporting the clients we've got, as opposed to going out and specifically building up a client bank. So yeah. Looking at more into pensions. So yeah, Jordan. Yeah, we've probably got some more information that we can share from that perspective, Jordan. So what I'll do, I'll get that sent over, and then like you said, sometimes your FD will be less focused on sort of talking about pension contributions on the basis that they might see their role as looking after your business. And we do see that because I just want to focus on looking after the business. Some people are like, look, I work for you, Jordan, so I'll do some digging. So we see both sides, but I can definitely get some information over to help from that perspective. And then like you say, at least it might give you something to talk with your FD about, but equally, one of the team can help as well. So I'll get back to you hopefully this afternoon with that, if it's okay. Perfect. Well, thank you very much all for attending. I'm going to end it now. So, like I say, we'll keep these coming, and yeah, have a great weekend.